Listen to me. I need you to lean in and pay very close attention to what I am about to tell you, because what we are going to talk about today could literally mean the difference between you living comfortably in your golden years or watching your hard-earned life savings get silently drained away. Over the past few years, I have seen a massive wave of slick marketing aimed directly at people who are either getting ready to retire or are already retired. You have probably seen the videos, read the books, or sat through a seminar where someone with a bright smile tells you that you can be your own bank. They call it the infinite banking concept, or a tax-free retirement bank, or privatized banking. They tell you to take your retirement money out of traditional accounts or put your excess savings into a permanent cash value life insurance policy, whether that is whole life, universal life, or indexed universal life. They promise guaranteed growth, zero market risk, tax-free loans, and total control over your money. And I get why that sounds so incredibly tempting. When you are 60, 65, or 70 years old, what is your single biggest financial fear? Your biggest fear is running out of money. Your fear is seeing a sudden market crash wipe out 20 or 30% of your retirement portfolio right when you need to start withdrawing cash to live on. Your fear is that taxes are going to eat up whatever you try to leave behind for your children or grandchildren. So when someone comes along and says, "Hey, put your money here. It is safe from market drops, you can borrow from yourself whenever you want, and you get a tax-free payout," your brain naturally wants to say yes. But I need you to ask yourself one fundamental question: is cash value life insurance actually a smart retirement bank, or is it one of the most expensive financial traps ever pitched to retirees? Here is the truth that these insurance agents will never tell you, because the commission they earn on selling you one of these policies is massive, often up to 80, 90, or even 100% of your entire first year's premium. First of all, life insurance is meant for one primary purpose: income replacement. You buy life insurance when you are young and working, when you have young kids, a mortgage, and dependents who rely on your salary every month to pay the bills. Insurance is there to protect your loved ones in case you die prematurely before you have had time to accumulate wealth. But once you are approaching retirement or you are already retired, and you have accumulated your savings, paid down your debt, and built up your nest egg, who is dependent on your income? Nobody! You have transitioned from the wealth building phase to the wealth preservation phase. You do not need income protection anymore. Second, never, ever mix insurance with investments. When you put your money into a cash value policy thinking it is a bank, a huge portion of your money in the early years goes straight toward hefty administration fees, agent commissions, and mortality charges. That means for the first 5 to 10 years, your cash value grows at a snail's pace, or barely grows at all. If you try to pull your money out during those early years because you have an emergency, you get hit with brutal surrender charges that can take away a massive chunk of what you put in. That is not liquidity. That is not a bank. That is a cage for your money. And it gets worse as you get older. Inside these universal and whole life policies, the internal cost of insurance goes up every single year as you age. When you are in your 70s and 80s, those monthly insurance charges soar. If the returns inside the policy do not perform as aggressively as the agent promised, those rising internal charges will literally eat away at your accumulated cash value. I have heard from thousands of retirees who paid into these policies for 20 or 30 years, only to receive a letter in their 80s saying, "Your cash value is depleted. You must pay thousands of dollars more every month just to keep this policy alive, or it will lapse, and you will face a massive tax bill on top of it." Can you afford that when you are on a fixed income? Absolutely not. So here is your actionable takeaway today. If you are retired or near retirement, stop looking for financial shortcuts or magical products. Keep your cash simple, safe, and accessible. If you need an emergency fund, put it into a high-yield savings account or short-term treasury bills where your money is FDIC insured, liquid, and completely under your control with zero fees or surrender charges. If you want tax-free growth and tax-free withdrawals in retirement, maximize a Roth IRA or look at tax-efficient, low-cost index funds in a brokerage account. If you already have a cash value policy that you were sold, pull out your latest policy statement immediately. Look at the current surrender value, compare it to what you have paid in, and consult an independent, fee-only fiduciary financial advisor, someone who does not sell insurance for a commission, to see if it makes sense to cash it out, surrender it, or exchange it. Remember, people first, then money, then things. Protect what you have worked your entire life to build, keep your money clean and simple, and do not let anyone convince you to buy an insurance policy when what you really need is peace of mind.